Welcome and kindly feel the classroom environment that you have created for you as we get ready to actually show this examiner that we can be able to make a replacement decision of an asset using the NPV. Now we have an extract of a CASNE past paper, that is 2016 CPA Financial Management, and the question is all about replacing an already existing asset. And we are going to go through the question as we extract the vital information that will be able to assist us in our working. Now, this is what the question states. Makaya Limited is considering the acquisition of a new machine to replace the existing machine currently being used in production process. Okay? The existing machine was acquired 2 years ago at a cost of 2 million. It was originally estimated to have a useful life of 5 years with no salvage value. We can now let us represent that particular information in a number, in a timeline. Now we have a machine acquired at year 0. Year 0 is acquired at the year 0 for the old machine, and its useful life was supposed to be 5 years, but it is now being replaced at year 2. Okay, at year 2. The cost at which this machine was acquired is 2 million. So the cost is 2 million. Okay. Then we are told that it had no salvage value. Salvage value refers to the value of an asset which remains at the end of its useful life after depreciation has been factored in, that is after subtracting the depreciation value. So this machine had no salvage value, it was a 0 salvage value. Okay, we continue. A critical evaluation of the machine now shows that the machine is usable for another 5 years with a salvage value of 250,000 at the end of this period. So it means that at year 2, at the time this particular company is considering replacing the old machine, and upon reevaluation, it is discovered that from year 2, the machine can be used for another 5 years. It means it will be used up to 2 plus 5 years, which is up to year 7. And we are told that at year 7, it will now have a salvage value of 250,000, which is equivalent to salvage value is supposed to be 0.25 million. Okay. Then, as we continue, we are told that the disposal value of the existing machine is currently estimated at 1.25 million. That is the disposable value. That is the value at which the old machine is supposed to be sold as the new machine comes in. So it means the market value, it will only be disposed at the market value. We are told it is 1.25 million. Okay. Then the new machine is estimated to cost 3.14 million, and its salvage value is 1 million at the end of its useful life of 5 years. Remember, the new machine is being replaced at year 2. It is replaced when the old machine has already been used for 2 years. So the new machine comes in at this particular juncture, and at from year 2, its useful life is 5 years. So it means we have 5 years. 2 plus 5 is supposed to be 7 years, and it will have a salvage value of 1 million. It means that is the value that is going to remain after depreciation factor. But now the cost of this machine is 3.14 million. Okay. The new machine will also require an additional investment in working capital of 650,000 at the start of the asset's useful life. Now, working capital is normally required to facilitate the normal operations of a particular production facilitation. So, at the start of the life of the new asset, we require a working capital of an amount of 0.65 million, which is the same as 650,000. But we're told again that the investment in working capital will however be recovered at the end of the 5 years useful life. So it means whatever that is being invested at the start of this asset useful life will be recouped back. In other words, it will form part of the terminal cash flows. Terminal cash flows refers to the cash flows which are received at the end of this particular asset's useful life. So it means it will be added to the purchase cost of this one when you are getting the initial cost, and also added to the terminal values to discover that. Now, the following information relates to the estimated earnings before depreciation and tax over the 5 years period for the two machines. Now we have from year 1 to year 5, we are given for the new machine, the earnings for the new machines and the earnings for the existing machine. And you can clearly see that the earnings for the new machines are higher than the earnings for the existing machine. So it means that there is some element of increase in cash flows, and that is why the new machine is being brought in. Then you're told the cost of capital is 10%, and the firm applies a straight line method of depreciation. Corporate tax is 30%, so we are going to use this value. But now this is not what the question requires. Using the net present value technique, advise the company's management on whether to replace the machine or not. Now we are going to get our NPV, and the machine will only be replaced if the NPV is above 0. That is, if it has a positive NPV. If our NPV will be negative or below 0, it means we will advise the company not to invest or not to replace the existing machine. Now, I want us to begin our work by determining what is known as the initial outlay. Remember, for us to get the NPV, it's always the present value cash inflow minus the present value cash outflow, which is the initial outlay. So before we get the present value cash inflow, we are supposed to get the initial outlay, and we are supposed to factor in the purchase cost of the new machine, and we are going to work in terms of thousands. So the new machine was purchased at the value of 3140. That is in terms of thousands. We are negating the 0 to make work to be easier. Then from this value, we are supposed to less the market value. The market value of the old. Because the old machine or the existing machine is being sold at the market value, we subtract that value to get the initial outlay that is going to be reinvested into the new machine, and our market value is 1.25 is equivalent to 1250. When you subtract these two values, you get an amount of 1890. That is 1.89 million. But now there's some element. When this old machine is being disposed of, an asset can be disposed at a loss or at a gain, and you only get to know whether there is a gain or a loss when you compare the market value with the book value. So we're supposed to get the book value of the old machine. So the book value the net book value of the old machine. And of course, net book value refers to the value of an asset which remains after subtracting depreciation. This one is supposed to be given by subtracting depreciation from cost. So the cost of that item minus what has been lost due to depreciation should give us the net book value. But now, how do we get depreciation? And we are told that it uses the straight line method. We are going to get the value that was lost between 0 years to 2 years. So you're supposed to get the depreciation per annum and multiply by 2. And how do you get that one? Because the salvage value was 0, but the cost was 2 million. It's supposed to be 2 million minus 0. You divide by the useful life, which is 5 years. Multiply by 2 to get the depreciation for the 2 years. When you do that one, we are supposed to get a value of, this is supposed to be give us a value of 0.8 million. But now that is for the 2 years, or we can confirm 2 divided by 5, 0.4 times 2 is 0.8. Then, of course, to get the net book value, I said is the cost. So it is NBV will be the cost, which is 2 million minus 0.8, what has been lost. So it means what is remaining on the old machine is 1.2. Okay, that is 1.2 million. So it means this asset was sold at let's see, the value of this asset is 1.2, then it is sold at 1.25. So it was sold at a higher price, meaning that it was sold at a gain. But we're supposed to add the tax on disposal gain to this particular amount that you got here. So when you add tax on disposal gain, because it was sold at a gain, and the gain essentially is 1250 in terms of thousands, this value, the price at which it was sold, minus 1200 times the tax, which you are told to be 30%, which is 0.3, we get a tax amount of 1500. That is the tax on disposal gain. It is part of the investment. Remember, we had an element of working capital, which is forming part of the investment. Again, we add our working capital, and our working capital is an amount of 650,000 in terms of thousands. When you add these two, we get an amount. So we're supposed to add these 1890 plus 1500 plus 650 is supposed to have an amount of 222, supposed to be 2555. This is our initial outlay, which will be subtracted from the present value cash inflow to determine whether there was to determine the value of the net book value. Then from that one, remember that we have some element of something to do with incremental cash flow. Now, for us to get incremental cash flows, we're supposed to factor in what is known as the incremental depreciation, and then get the terminal values. So we are supposed to have something to do with incremental. Remember, when the new machine is being brought in, there will be some element of depreciation, that is because it will also be charged a loss of value. And under this one, we are supposed to factor in the depreciation of the new machine. And because we are using the straight line method of depreciation, we are supposed to have its cost, which is actually 3140, minus the salvage value, which is 1 million, which is 100, because we're working in terms of thousands, divided by the useful life of 5 years, and we get an amount of 4. You can work it and see what we get actually. 3140 minus 1000 is supposed to be that one divided by 5 is 428. So we have 428,000. Then you talk about the depreciation of the old machine, which is again its cost, which was 120. Cost was 120. 1200 minus salvage value, which we are given to be 0.25 million, which is 250,000, divided by its useful life upon revaluation, which is 5, and we get a value of 170. So for us to get the increase, we subtract these two. So when we subtract the two values, we are supposed to get, this is an amount of 190. So for us to get the increase, it means we subtract what we are getting rid of the old machine from the one that is being introduced, to get what is known as an amount of 238,000. But remember, there's an element of what is known as depreciation tax saving. So we have depreciation tax saving for every amount of what is being charged as depreciation, which is supposed to be 30% times 238, and we get an amount of savings to do with 71,000. So we can do it. 238,000 times 0.3, we get 71,400. This one will be added back when you are getting the incremental cash flows. Then thirdly, we get what is known as the terminal cash flows. Terminal cash flows. Now, terminal cash flows, we are going to factor in the element of the savings, the salvage values of the old machine and the salvage values of the new machine. Now, we are supposed to talk about the salvage value of the new machine, which we are essentially given as the new machine had a salvage value of 1 million. So 1,000, we minus the salvage value of the old. We are minusing the old machine salvage value because we are getting rid of that, and it was an amount of 250,000. When you minus, you're supposed to get an element of 750,000. But now you see, this is the new salvage value. We are told that in the question, we are told that this working capital, which was reinvested at the beginning, of course we added it here, was recovered at the end. So it means it's forming part of the terminal cash flow. So it's supposed to be added. We add the working capital here because it is forming part of what was recouped at the end. And when we add an amount of 650 we get 0,014. So we get an amount of 1,440,000. So under discounting factor, we are going to factor it in our working. Now, having this one into our working, I now want us to copy paste. I have simply copy pasted the question. We were given the year and the earnings before depreciation and tax for the new machine are given from 14 to 12. That is what I've written, 14 to 1200. And then for the old machine, again, we're given from 800,000 to 600. That is what I've written. I've simply copy pasted. Now we are supposed to get what is known as incremental, the increase in earnings before interest and tax. So increase in earnings before interest and tax. We simply get the difference between these figures because they are forming a part of the cash flows. They are retained into the particular business. And when you do that one, for this one, you're supposed to have a value of 600,000. Remember, we're working with thousands. In this case, we have a value of something to do with an amount of 650,000 again. Here 650,000. When you go to the next one, we are supposed to have a value of 550,000. Then the next one we have a value of 800. You can see it is 800,000. The last one is 600,000. That is the increase in profit before interest and tax. Then of course it is before interest and tax. Let us now, it is before depreciation and tax. Let us now factor in the element of taxation. So less tax, and tax was done at 30%. So if you done the tax at 30%, we get 30% of this one should be 180. Should be 180,000. 30% of this one should give us something to do with the 195,000, which will be subtracted. Then here we have 30% of this one, which is supposed to be 1650, will be subtracted. Then we have 30%, this 65, sorry, let's get 30% of that one. 0.3 times 550 is 165, sorry, not 1, so it is 165. Then 30% of this one again is supposed to be to 40,000. 30% of this one is supposed to be 180,000. After that, we have what is known as earnings after tax. We have now charged the tax, and the tax charged here, in this case, we have the earnings as 420. Here we have the earnings as, and it's actually supposed to be 455, 450, 455. Then we have 385, and we subtract this one, these two, we get an amount of 560. And finally here we have 420. But remember, we had an element of what is known as depreciation tax saving. For every depreciation charged, some tax was saved, and whatever you save from the tax paid is being treated as part of the cash flows. So we are supposed to add depreciation tax saving, and this one is uniform for all the years because that is what was charged. So it is 71.4, 71.4, 71.4, 71.4. When we add those ones, we are getting what is known as terminal cash flows. Now, terminal cash flows, it means that it's supposed to be the annual cash flows. When the R is supposed to be 91.4, this is 526.4 million. Here we have 5, so it is supposed to 456.4. Here 631.4, then 491 again, 91.4 for the last value. Then after that, remember there's an element of what is known as the terminal cash flow. Now, terminal cash flow is essentially forming part of the last year. It is being recouped back. So it means for these years there is no terminal cash flow. Remember, the value was arrived at as 1400. That is so we're supposed to add an amount of what to do with 1400. It is being recovered back according to our equation or according to our problem. Then of course we have the cash flows now. The cash flows, after factoring in the total cash flow, for this one they will remain the way they are, 491.4, 526.4, 456.4, 631.4, but these are now we add the 2 and we get an amount of 1891.4. Really 18? Yeah, 18. Yeah, it's supposed to be 1891.4. And that is how we get it. And these are now the cash flows which are supposed to be discounted using the present value. So we have the present value interest factor at 10%, and we have to get this one from the table. Now from our table, present value interest factor at 10%, for 10% for year 1 is 0.9091. For year 2 from the table is 0.8264. Then year 3 is 0.7513. Then year 4 we are given as 0.6830. Then for year 5 at 10%, 0.6209. So it's supposed to be 0.6209. So it is the same as when you multiply these two, you're supposed to get what is known as the present value cash inflow. And when you multiply these two by this one, it's supposed to have a value of 446.73. 446.73. Here we are supposed to have, when you multiply these two by the discounting factor, we get a value of 435.1. Then of course for year 3 we get a value of 342.89. And then of course here we get a value of 431.246. And then the last year multiply the 2, we get a value of, to do with 1174.37. Now these ones we add all these one and subtract the initial outlay that we had before. So when you have the present value of cash inflow, their total is supposed to be 2830.258. But now we multiply by 1,000 because you are working in thousands, so it's supposed to be 2 million. But now then again we talk about our present value. We subtract our present value cash outflow, which is actually the initial outlay of 2,555,000, which essentially we subtract 2,555,000. Whatever we are going to get is the net present value, and the amount is 275,258.48, because there was some decimal place here we omitted. Now, because our NPV is positive, so our decision simply is replace the existing machine. Thank you very much. It has been a long journey, and I hope that you understand every aspect, and kindly feel free for more videos that will follow. Thank you.